There's really three different strategies as real estate investors we can focus on implementing in order to achieve those goals. The first one is cash flow and debt repayment. The second one is forced appreciation, and the third one is natural appreciation. Now for myself, Matt McKeever, I've really been focused on the first two investment strategies there, so cash flow and debt repayment, as well as focusing on forced appreciation. And this is really what the BRRRR investment strategy is all about. And when we're thinking about the BRRRR investment strategy, in order to figure out which properties have potential, which properties make sense for our investment strategy to make sure that we're getting cash flow and debt repayment every single month, we need some rules of thumb in order to be able to quickly analyze properties. One of my favorite rules of thumb in order to determine whether a property is going to cash flow while still servicing the debt and paying down the mortgage every single month is what we call the 1% rule. So the 1% rule, simply stated, means a property value should equal the month. Jeff, are you confused about what a good real estate deal is? Well, then you need the 1% rule. Do you want to speed up your deal analysis? Well, then you need the 1% rule. Want to learn how to analyze a property for cash flow potential in under 10 seconds? Then you need the 1% rule.
Wait, did he just say 10 seconds or less? That's faster than I can put my pants on. 1% rule.
In order to succeed as a real estate investor, it's extremely important that we can quickly analyze real estate opportunities. One of my favorite ways to initially analyze a real estate deal is using the 1% rule in conjunction with the 50% expense ratio rule. Now, we're going to dive all into that in today's video, and we're going to show you exactly how you can go about analyzing a rental property in under 10 seconds. Before talking about the 1% rule, let's first talk about real estate investing in general. Now, most of us get into real estate investing to either increase our net income or increase our net wealth. There's really three different strategies as real estate investors we can focus on implementing in order to achieve those goals. The first one is cash flow and debt repayment. The second one is forced appreciation, and the third one is natural appreciation. Now, when we're talking about cash flow and debt repayment, this is a strategy a lot of us are very familiar with. This is where you go buy a rental property, and every month the difference between your income and your expenses, that spread, you're able to spend that cash flow and live off of that, or start replacing your personal income, your retirement fund, whatever you're kind of focused on as a real estate investor. In addition, with each monthly payment that we're making on our mortgage, there's a principal aspect and an interest aspect. That principal repayment, that's also slowly building equity in the property for us. The second investment strategy is forced appreciation. This is where we're taking an underutilized, less efficient asset and bringing it up to its highest best use. So oftentimes this is buying properties that are under rented, properties that have deferred maintenance, properties that are not just in their best use, and we're bringing them up through strategic renovations in order to get the best rents, to get the best forced appreciation. And then finally, the third investment strategy we can focus on is just natural appreciation. So we live with fiat currencies, and what that means is inflation is just kind of inherently a thing for most Western societies, most Western civilizations. You know, our governments peg inflation often at 2 to 3% as their target rate. What that means is, as an investor, we can assume that most assets are going to appreciate, most assets, the value I should say, are going to appreciate at a 2 to 3% rate at least. Depending on the demand, depending on your market, you may actually be dealing with an even higher natural appreciation rate. It really depends on your market though. In general, these are the three investment strategies we as real estate investors are constantly focused on in order to grow our net income and our net wealth. Now for myself, Matt McKeever, I've really been focused on the first two investment strategies there, so cash flow and debt repayment, as well as focusing on forced appreciation. And this is really what the BRRRR investment strategy is all about. And when we're thinking about the BRRRR investment strategy, in order to figure out which properties have potential, which properties make sense for our investment strategy to make sure that we're getting cash flow and debt repayment every single month, we need some rules of thumb in order to be able to quickly analyze properties. One of my favorite rules of thumb in order to determine whether a property is going to cash flow while still servicing the debt and paying down the mortgage every single month is what we call the 1% rule. All right, right, now let's dive into exactly what the 1% rule is. I'm also going to share some theoretical examples for you, and later in the video we'll dive into some real life examples. So the 1% rule, simply stated, means a property value should equal the monthly gross rents divided by 1%. Or another way of looking at it is monthly rents should equal the property value times 1%. Now this is actually a pretty simple concept, and this may sound sort of familiar to some of you real estate investors that have been in the game for a while, because we also have another rule of thumb or another metric that's used called the gross rent multiplier. And so the gross rent multiplier simply takes the property price or the property value, divides it by the gross rents, the gross monthly rents, and that equals your GRM. So a $100,000 property that's getting $1,000 a month in gross rents, that's going to be 100 GRM, or that's going to be the equivalent of a 1% rule deal. Now let's dive into some real life examples here for you guys. So examples, a $200,000 duplex, and this is something you can actually do here in London, Ontario, where I'm based out of. A $200,000 duplex that rents out for $2,000 a month in gross rents, that's going to meet our 1% rule. A $3,000 rent property should be valued at a $300,000 valuation based upon the 1% rule. Then we have a property, let's say, that needs a little bit of renovations. Maybe it's worth $150,000 but needs $50,000 in renovations. Well, in that case, the total value or the total cost of the property for us is $200,000. So if we want to make sure that that property met the 1% rule, we're going to need to get $2,000 a month in gross rents. Alright, now let's talk about exactly why the 1% rule works. As we mentioned earlier in the video, the 1% rule is a really nice rule of thumb for us to use in order to determine whether a property is likely to cash flow or not. So when we're looking at the 1% rule, well, why does it work? Well, if we take the 1% rule, that rule of thumb, and add in a few other rules of thumbs and assumptions, we can build out a base model for analysis on a potential rental property. So we also in real estate investing have what we call the 50% rule. Now the 50% rule, simply stated, means that on average, in general, when we're looking at the gross rents of a property, the assumption is that 50% of that is going to be our monthly expenses to operate the property. Now, obviously, this is just a general rule of thumb. You need to do a lot more due diligence before you ever buy a property. But when we're doing our quick analysis, this is really valuable and really helpful. Now, one thing that a lot of commenters are going to jump in and likely say is that the 50% rule is kind of vague. And yeah, it is. In general, I like to think of it really as the 40 to 60% rule, because it's going to depend on the exact situation, the exact market, and the exact details for that property. But if we use the 50% expense rule, then we make an assumption that we're getting an 80% loan to value on our mortgage product. And again, loan to value simply means that if we buy a property for $100,000, the bank will give us an $80,000 mortgage. This is pretty common in Canada. In some other markets, it may be a 75% loan to value. But in general, it's essentially the same thing. And so loan to value we'll often also call LTV in the real estate game. So let's take these and apply it to a $200,000 property that's meeting the 1% rule, or in other words, is getting $2,000 a month in gross rents. So if we're getting $2,000 a month in gross rent and we apply the 50% expense rule, that means we're going to have $1,000 in monthly expenses. Now, if we add on our mortgage payment, and in this situation, for this mortgage, I've made an assumption of $200,000 at an 80% loan to value gets me a $160,000 mortgage principal amount at a 3.5% interest rate for a 25-year amortization period, works out to approximately $800 a month in mortgage payment. Now that mortgage payment will have a principal and an interest aspect, but from a cash flow perspective, we just really want to know, after we pay all of our expenses, after we pay all of our cash outflows, what is the net cash we have remaining? So in this basic example, $2,000 subtract $1,000 or the 50% expense rule, subtract the $800 mortgage payment, is going to leave us with net cash flow of $200. Now, again, this is a very high-level rule of thumb application, but as we can see, this lays out for us in basic principle how the 1% rule works. I'm going to stop you before you even get started complaining. I know a bunch of you are going to jump in asking what's included in that 50% expense rule. Okay, don't panic. We're going to dive into that right now. So in general, in my market, in London, Ontario, in Ontario, Canada in general, when we're talking about the 1% rule, we're usually actually talking about us, the landlords, being responsible for the utility payments. So for example, if we're doing 1% and we're paying utilities, the way I like to view it for units or properties where the tenants are going to be paying their own utilities is instead of calling it the 1% rule, we're going to call it the 0.8 or the 0.9% rule. So what that means for us is if a property's, getting $900 a month in gross rents, and they're paying their own utilities, we would still value that at $100,000. Or a $100,000 property where the tenants are going to pay their own utilities, we should be looking for approximately $900 a month in gross rent. Now again, reminder, these are rules of thumb. In the future video series on the 1% rule, we're going to dive a lot deeper into real life examples and really get into the granular numbers for you guys. But it's really important that you understand high level, if we see a property and its gross rent multiplier is 100, or if we find a property that meets or exceeds the 1% rule, there's a really strong indicator that that property is going to be a strong cash flow investment property. And if you're focused on an investment strategy like myself, if you're focused on trying to find BRRRR opportunities, that's the type of property that you're going to want to acquire. That's it for this video, guys. This is part one of a three-part video series focused on the BRRRR investment strategy. In part two, I'm going to be breaking down a real-life example from here in London, Ontario. In fact, it's a deal that myself and my wholesalers assigned to one of our mini investors in London, Ontario. If you guys are interested in signing up for our wholesaling email list, I'm going to throw a link in the video description down below. Otherwise, in part two, we're going to break down that real-life example. And in part three, we're going to talk about some of the downsides of the 1% rule, why you can't only rely on the 1% rule, and then what to do once you've found a 1% rule property. If you guys enjoyed this video, if you're enjoying this video series, smash that like button. If you're new to my channel, make sure you hit that subscribe button. And until next time, remember, making money is a team sport. There's more than enough money in this world for us to all make it, but if you're not saving it, what's the point? Thanks, guys. Bye.